Do we want to buy in a limited company or in your personal name? Welcome to a discussion in property investment. Should you buy property in your personal name or through a limited company? Now this is the big question, but the thing is it's more than just a matter of choice. It's about strategy, it's about tax implications and the long-term planning. So if you're ready to delve into the intricacies of property investment, show your support with a like, subscribe, and don't forget to hit that notification bell so that you never miss any incredible content. So why this matters? Well, property investment has always been a popular route to financial freedom in the UK, but the landscape is ever changing, and in recent years, particularly since 2021, tax reforms have promoted a significant rethink in the investment strategies of those investors and landlords. Now, traditionally, buying property was straightforward, often done with personal names, but then came a seismic shift in a legislative change known as Section 24. It's this change that has sparked a debate. Is it better to invest personally or through a limited company? Now, the answer isn't just straightforward, it's a nuanced decision that depends on several different factors, including your tax, your situation, long-term goals, and the scale of your property ambitions. Now, let's take a step back for a second and look at property history. For years, buying property in one's own name was normal. It was simple. It seemed to offer the best tax advantages. Enter Section 24. This new tax legislation transformed the way property income and mortgage interest are taxed, particularly for those in the higher tax brackets. The result? A once clear-cut decision now required a more strategic approach, and investors began to ponder the potential benefits of a limited company ownership versus their personal name, where traditionally they would have bought. Now, understanding Section 24. Section 24, often referred to as tenant tax, has dramatically altered the financial landscape for property investors like you. It reduces the amount of mortgage interest and other finance costs that landlords can offset from their rental income before calculating their tax bill. So this change has particularly affected the higher rate taxpayers, leading to many considering buying in a limited company as opposed to in their personal names, which is now a more efficient option. But is it? So personal ownership, let's just look at that for a second, because it's not to be discounted based on where we are today. Consider this scenario. You own a property generating £800 a month rent, totaling an annual income of about, well, that's 9,600 quid, right? The mortgage interest is 560 quid a month, equating to £6,720 a year. Now, in the past, you'd simply subtract the interest from your income to determine your profit. However, now that Section 24 is in full force, this straightforward calculation has now been complicated. For the higher tax earners, the government now takes the entire rental income, not just the profit after interest. This change has substantially increased the tax liability for individual property owners. Now, let's just take a second to look at the tax implications and the impact that that's had on a lot of landlords and investors in the UK. Now, under the new system, the higher rate taxpayers face taxation on the full £9,600 income, with only a partial relief for the mortgage interest. This 20% relief is a concession, but still a kick in the knackers because it doesn't fully offset the increased tax burden. Consequently, personal property owners are now seeing a significant reduction in their net profits. It's a shift that has made many reconsider their investment structure and also a mass exodus of landlords. Now let's look at it from a limited company perspective. In contrast, let's examine owning property in a limited company. The rental income and the mortgage interest figures remain unchanged. However, in a company setup, mortgage interest is still a fully deductible expense. This means that the company pays tax only on the actual profit after deducting the mortgage interest. Now, for many years, this presents a more appealing financial picture, especially considering the current corporation tax rates. But does this make company ownership unequivocal as the winner? Well, let's break it down. Let's look at the pros and let's look at the cons of owning property in a company. So, Owning property in a limited company has several advantages. The most notable is the ability to deduct that mortgage interest as a business expense, this lowering taxable profit. Now, additionally, the current corporation tax rate, although subject to potential future increases, is generally lower than the higher individual income tax rates. Limited liability is another benefit. The company owns the property, not you personally, providing a layer of protection. However, company ownership is not without its downsides. Firstly, future increases in corporation tax could diminish its current appeal. Secondly, obtaining a mortgage might be more challenging with higher interest rates often applicable to company mortgages. And lastly, running a limited company involves additional administrative duties and costs, which to me is a pain in the arse, including the need for comprehensive accounting services, which are going to cost you as well. Now, looking at personal name consideration, let's just dive a little bit deeper into this. For those in the lower tax bracket or those planning on retiring, owning property in your personal name can still be the advantageous option. Personal ownership is typically simpler for those with smaller scale portfolios or with lower incomes, and the tax implications are less severe. So this route can also offer some flexibility in terms of mortgage options and easier access to rental income. Let's look at making the right choice. Choosing between personal and company ownership is a complex decision that should be tailored to your personal individual circumstances. So whatever you hear in this video, I'm here to guide you, but you still should seek professional financial advice on this. It involves considering your current tax bracket, future income projections, retirement plans, your overall property investment strategy. So whether you aspire to build a vast portfolio or just a few rentals to supplement your income, the structure of your investments can significantly impact its profitability and tax efficiency. Sorry guys, my words aren't coming out today. It's Friday, and after I've done this video, I'm going to be chilling this weekend. So let's talk about consulting with the experts. Now, given the complexities involved, consulting with a financial and tax expert is crucial. A qualified accountant or tax advisor can provide you with really expensive personalised advice based on your specific circumstances. That's going to help you navigate the intricate tax laws and make more informed decisions that align with your investment goals, therefore making you more tax efficient and paying less tax and more profit, which goes in your pocket at the end of the day. For personal ownership, the tax is based on your personal tax band, which could be as high as 40 to 45% for higher earners. This means a substantial portion of your rental income could go towards tax. Conversely, with a limited company, it's taxed at the corporation tax rate, which is currently significantly lower. Now, this difference can have a major impact on your net returns from your property investments. But there's some other stuff to consider here as well. Let's talk about capital gains tax. That is something very important that we need to consider here. And another critical aspect, capital gains tax. Now, when selling a property owned personally, capital gains tax is charged at 18 or 28% depending on your tax band. However, for a limited company, capital gains tax is effectively the corporation tax rate, which is currently lower. So this can make a substantial difference in the profit you retain after selling a property. So if you're going to be doing flips, this is another consideration. It's also about the strategy that you implement. Now, let's talk about taking dividends and taxation on that. For those considering a limited company, it's crucial to understand dividend taxation. When you extract profits from your company, they are taxed as dividends. The rates for dividends taxation can vary, but can add an additional tax burden, affecting the overall efficiency of this structure. So you need to balance salary and dividend extraction. That is key to optimizing your tax position. Now let's look at flexibility in extracting profits. Profit is why we're doing this, to put money in our bank accounts. Now, flexibility in assessing your profits is another aspect you need to consider. Personal ownership allows for more immediate access to rental income, whereas extracting money from a limited company involves navigating dividend taxation and potentially additional administrative steps. For me, this is a pain in the arse, but there are tax advantages for me to do it that way. Now, What should the long-term strategy look like, and what are your goals? This is what you need to think about. Your long-term investment strategy and goals play a crucial role in deciding between a personal purchase or a company purchase. If your aim is to build a substantial property portfolio, a limited company might be the more advantageous way to go due to its tax efficiencies and scalability. But if your goals are more modest, the simplicity of personal ownership could be way more appealing for you. Now, there's another aspect to think about here, legals and liability aspects. So, limited company ownership provides a degree of separation between you and the investment itself, potentially offering protection against personal financial risks. Now, don't be fooled, because 9 times out of 10 a lender will ask you to do a personal guarantee for a limited company mortgage, which means that if you liquidate that and go under, you will still be personally liable for that mortgage. Now, let's look at market trends and the future and some predictions. Crystal ball, if I had one, I would have a lot more money. So, this is my assumptions. It's also important to stay informed about market trends and future predictions. Changes in tax laws, interest rates, the property market dynamics can influence the suitability of each investment structure over time. Keeping abreast of these changes can help you adapt your strategy to maintain optimal profitability. So, seeking professional advice. It's worth every penny, but don't get me wrong, it's expensive. And I say it's expensive, I work with some incredible people, but I'm as tight as a duck's arse, right? So given the complexities involved in property investment, seeking professional financial advice is paramount. An expert can help you navigate the tax landscape, understand the nuances of each structure, and align your investment strategy with your financial goals. So, in conclusion, whether you choose to invest in property through a limited company, or if you choose to invest in property in your personal name, depends on a number of factors, including your tax situation, investment goals, appetite for administrative tasks, which no one wants to be doing. Both routes have their merits and their challenges, and the best choice varies from investor to investor. It's different for every single person. So in conclusion, today's exploration of property investment structures, remember that making informed decisions is key in the dynamic property market. And as they say, knowledge is power. Staying well informed and seeking expert advice can make all the difference in your property investment journey. For more insights, for more training opportunities, check out katywilsonproperty.com, and that's K-A-T-Y, not I-E. The link is in the description below. Hopefully this video has offered you valuable insights. Please show your support with a like, subscribe, hit the notification bell, and please comment. Your engagement helps us create content that is more beneficial to you, and I'm eager to hear what your thoughts are, especially on today's topic. Please leave a comment below. Your input is invaluable. It's going to help me shape the future discussions and help me grow the channel to bring other people more value. Thank you so much for joining me today, and I look forward to seeing you in the next video.